How's it going, guys? It's your boy Mike from Seattle, and today I'm with my tax pro, my CPA Evan Kirkpatrick. Evan, go ahead and say hey.
Hey, everyone.
So this is Evan. He has been my tax pro for this last year. He was referred to me by my mentor, Mark, if you've seen Mark on my channel before. Evan, real quick before we get started, if people like what they hear from you, what's the best way to get a hold of you?
You can find us at kirkpatrickpllc.com. Link will be down in the description below, I'd imagine. Or you can always call our office at 512-246-9669.
Perfect. Thanks, Evan. So, Evan, I really want to know a little bit more about you. I mean, from my perspective as a blue-collar guy, I'm scared to death of numbers. So what got you interested, and what's your resume and your history with being a tax preparer?
It's funny because I don't know why I wound up choosing accounting as my major, but I also never really considered doing much else. So, I guess it was just my destiny. I've been a CPA for about 11 years now. I went to the University of Texas at Austin for my bachelor's and master's degrees in accounting. And I've been working in tax ever since before then. During that educational period, I was a specialization in tax at UT. Been working in public accounting for my entire career since then, working in various tax departments, starting a national firm in Houston for about 6 years. Spent a little bit of time in a regional firm between that and starting this practice here in the suburbs of Austin, where we are serving both businesses and business owners and also individuals that have more than a baseline level of tax needs, either via owning small businesses, side businesses, large amounts of investments, or in this case, very frequently, rental real estate, where we're trying to make sure that we are giving the level of tax advice in an efficient manner that a rental real estate owner will need in order to not lose out on the best opportunities that they can find while they're growing their portfolios.
Yeah, and so for folks who don't know Evan as well as me, Evan has done business and worked for me, my mentor Mark, who has a YouTube channel, my friend Caleb, who's part of my mastermind investment group. And really the key takeaway here that you're going to learn about Evan as we talk in these next several videos is that he knows real estate, and he knows real estate pretty darn well, which is key when you're going to have someone prepare your taxes and you're a real estate investor. Evan, am I right about that?
Yeah, absolutely. Context is crucial for everything when it comes to tax planning.
Yeah, so for the folks out there who've been following my journey and acquiring rentals and things like that, when I first bought my duplex, I still did my own taxes. And then I paid a professional to do it the next year, and I didn't have a great experience. And my mentor, Mark, who has a YouTube channel I mentioned earlier, recommended you. So I used you for tax year 2020, and I had a fantastic experience. So what I wanted to do today was give a little bit of advice to newbie real estate investors such as myself and get your thoughts on it. So for the first question for you, I want to talk about what are the biggest mistakes that brand new real estate investors make when it comes to filing their taxes.
There's a couple things that come up pretty frequently. One isn't, the most frequent thing I see, and it's not a filing mistake, it's not a mechanical mistake, it's a headspace mistake, is that there's all this talk out there in the bigger pockets world and things like that about the tax advantages of real estate. And people are like, I'm going to get into real estate, I'm going to save a bunch of money on my taxes. That may work out, but there's a lot of circumstances where you're not going to just buy a bunch of rentals and immediately chop a bunch of money off of your tax bill. That's not the way the system works. Rentals are governed by something known as the passive activity loss rules. And without getting neck deep in a college level course on tax law, the bottom line of it is that with passive activities like real estate, there are only limited circumstances where you are allowed to deduct a net loss on those activities on your taxes as someone that isn't a real estate professional. Rentals are special. There is a carve out in the tax law that for people at a certain income level or below a certain income level, where you are allowed to deduct a certain level of rental losses against your W-2 income, your day job. But if you're above that income level, or even if you're below that income level, you can deduct some, but not all, if you have a huge rental loss. Or if you're above that level, you can't deduct a rental loss against your W-2 income. Like if you're out there and you're making $300,000 a year, great. And that gives you a lot of opportunity to invest in real estate, but we're not going to be able to like generate some $75,000 loss and deduct it against your W-2 income under ordinary circumstances. And so you have to have the right mental head about, okay, what are my expectations out of what I'm going to get from a tax perspective when I deal with real estate?
Okay, so what I heard right there was, depending on what your income is, there's people who make 50 grand a year, 150 and 300 a year. Depending on where you're at, you may be able to deduct some of the losses from your rental properties against your normal W-2 income and bring that taxable income down. So you can save a little bit of money on your taxes. But really, if you make too much, then that opportunity kind of goes away. Is that sort of what you were saying?
Yeah, and long term, what's great about real estate from a tax perspective is that once you're cash flowing, once you're making money, you can buy more rentals and you can do lots of stuff to use those rentals to offset the income from the earlier ones that are making more money, that have like they've had their debt service inflated away, or they've just grown and they're in stronger markets. So hey, we're making a lot of money on our earlier rentals and now we're buying more. You can definitely use those rentals to offset the income from the first. But when you're starting out, rental one, rental two, it's not necessarily going to be a tax windfall right away.
Okay, yeah. So I guess where that would sort of come into play is you're a rich doctor making 300 grand a year, and you think you've figured out how to bring your taxable income down. So you're going to buy like 1 or 2 rental properties, but at the end of the day, it doesn't usually work quite like that. However, if you have, in my case, I have a duplex and 3 other rental properties. I can use the losses from all of those rental properties to affect the income that I'm generating in rents from the rentals. And that one's a little bit more seamless and beneficial.
Yeah, exactly. Once, we've seen this with a number of people where, hey, maybe they've got 1 or 2 rentals that they've had for a long time. Like they bought a couple early on, they bought 1 or 2 early on, or, it's a house. A lot of times really what it is we owned this house, we lived in it for a number of years. Now we're moving, now we're going to keep it, rent it. Well, I live in Austin. And so, here real estate. And so, someone that bought a house in 2006 here or something like that and is renting it now, well, that house is worth 2 or 3 times what they paid for it. And that's a scenario where even if it's mortgaged, they're going to make a lot of money on it right away just because they got into the house dirt cheap. Well, if they buy a second rental, they're in position to use that second rental through, manipulation of depreciation in particular, which I'm sure is a concept that's going to come up before we're said and done here, to offset that first rental and lower their bill collectively.
Okay. Yeah, and so you brought up appreciation. So really the depreciation, the 2 things that I think are the most popular tax benefits that an average guy like me would know about are, hey, when I buy a rental property on a mortgage, I'm paying interest on that mortgage to the bank. I can write off that interest. And then the second is depreciation. So I really want to talk about depreciation because there's actually different types of depreciation. Can you explain that a little bit more for us?
So with depreciation, we're dealing with a few different things. When you buy, let's just say you're buying a run-of-the-mill single-family residence or duplex, it doesn't really matter if it's 1 door or 8 or even more, but let's just say you're buying a single-family residence or duplex. You're buying at least 2 different assets as far as tax law is concerned. You've got 1 closing statement, but you've got a couple different assets. One of which is the house itself. We have a house. And it doesn't matter if it's a duplex or, it really doesn't matter if it's an apartment complex at the end of the day as far as tax law is concerned. But we've got this building here. Asset number 2 is the land that the building is on. You have to allocate our purchase price between those 2 assets. The reason for this is that land is not a depreciable asset. What does depreciation even mean? Well, depreciation is a tax law concept where an asset that is used in a business or an income producing activity, you are allowed statutorily to recover your cost in that basis via tax deductions over a certain period of time. In the instance of a house, that period of time is generally 27.5 years. Each year you own that rental property, you take your tax cost in that house, take 1/27.5 of it, however you pronounce that. goofy fraction. But you take that and you get a tax deduction for that amount. And it reduces your deemed cost in that house by that amount. You can't depreciate land. Land just sits there. If I went and say, hey, I'm going to buy a $100,000 piece of land and I'm going to rent it to someone to put cows on it, I don't get depreciation deductions. It's just land on that. But on that house, you get to recover it. This is very much distinct from any time you're talking about things like marketable securities. You know, for most people, the most immediate comparison in terms of what I can do with my money is I can keep this money and I can invest it in the stock market, or I can buy real estate. Well, a stock market, if you buy ExxonMobil or something like that, for instance, okay, you get dividends. You buy some Apple stock, you get some dividends, but you don't get to deduct a portion of your cost in those securities while you still own them. That cost just sits there until you sell it. But with real estate, you recover your costs during your ownership period. To the point where if you own a house for 3 decades, you get to the end, and that house, you don't have any tax costs in that house anymore. And that's why real estate is inherently powerful as an investment concept, as when you're looking at it in comparison to marketable securities, because you get that cost recovery during your ownership period. You can own it in perpetuity. Big point of coordination with that is that under current tax law, and it's been like this for a long time, people talk about changing it at times, but under current tax law, when you die, your heirs, your estate, takes a deemed tax cost in your assets equal to their fair market value at date of death. So that if I buy a rental property, and let's say I'm going to buy this rental property, I don't intend to ever sell it, I'm going to leave it to my kids. You know, this is a big part of their windfall, their inheritance, is that, hey, you're going to own these rental properties. So I buy this, $200,000 house. Let's just say there's $200,000 that's allocated to the house itself, and then there's $50,000 allocated to land. Well, over 30 years, I take $200,000 in tax deductions related to that house, and then year 31, I die. Well, when my kids get this house, their tax basis in that house, their tax cost in that house isn't $50,000 if they go to sell it. Mm-hmm. It's equal to whatever the fair market value of that house was on my date of death, which, that could be $1 million.
Right.
And so that house is worth $1 million. They take $1 million tax basis. They go sell it. They get $1 million and pay no tax.
Wow.
That's, that whole system in there is where you can really win with real estate versus with marketable securities, mutual funds, stuff like that.
Right. Yeah, that's impressive. So summarizing what you said, you can't depreciate the entire purchase price of your house, because realistically, when you buy your $200,000 house, some of it's for the house, some of it's for the land. So you have to figure out, and is it you that figures out what portion of the property actually can be depreciated?
You're allowed to make a reasonable determination. Usually what we're doing is we're using county appraisal district records. Because, who knows? And usually they're probably pretty conservative, actually, versus what the value of the land is versus the structure. If it's in a situation where, hey, like in Austin right now, where CAD values are massively lagging what market values are, just because there's been this huge spike right now. Well, we're still using, or you're going to use whatever the CAD value says that the land is worth, because it's the one thing out there that we can say for sure, hey, IRS, we didn't determine this.
Right.
An independent government agency came up with this value.
Yeah, so don't get mad at us and fine us and try to figure stuff out.
Yeah.
Okay. So you can depreciate what the house is worth, and you obviously, you as you mentioned, you can, the weird fraction, you can take the house and divide it by 27.5 and then depreciate that 127.5 each year.
Yep. Yeah,
Okay.
There's a special line item on Schedule E, the rental line, that's depreciation expense. That's what that's for.
But now, so then at the end of that time, let's say 15 years in, you've been depreciating at 127.5 for 15 years. 15 years in, you decide, I'm going to sell it. What does that look like? What kind of storm does that cause? Because obviously the house value didn't go down. You're probably going to be selling it for more than what you actually purchased it for.
So your deemed purchase price, whenever you sell an asset for tax purposes, it's sales price minus purchase price equals gain. Most easily, again, seen with like stock. I buy a share of Apple for $1,000. I sell it for $1,200. I have $200 a gain. With a house, you still have that same logic, but to the extent that you've taken depreciation deductions, that reduces your tax cost. And so I have my $250,000 property. I've taken $75,000 of depreciation deductions. So I have a tax cost of $175,000 when you go to do that calculus. And there's a few other minor things related to that. But the long and short of it is, okay, I have $75,000 less tax cost than I did originally because I've gotten those deductions already.
Okay.
And so that can either cause more gain, or there are ways to mitigate that. One that a lot of your viewers have probably heard of is the Litecoin Exchange under Section 1031, which is, its core originally was an actual trade. You have a piece of land, I have a piece of land. Well, let's swap them because I'd rather have yours and you'd rather have mine. In doing that, that's not a sale for tax purposes. The gain is deferred into the future. In modern use, the IRS has essentially allowed a structure where via the use of an intermediary company, and they're purpose-built companies that do this, various exchange companies out there, usually they have the number 1031 in their name, so they're pretty easy to find. You can do it where I have a property using this intermediary, it goes into some sort of trust type vehicle. The property is sold. We then have 180 days to close on a successor property. And as long as that money stays inside this intermediary vehicle for the whole time, then we get to defer our gain on the sale of the original property.
Right. So you can just continue to defer taxes and conceivably 1031 exchange up until the point where you die. And then as the benefit you explained earlier, your heirs would have all those savings and just go on the date of death, the value of the property at that point.
That would be the optimal scenario from a tax perspective, typically. Under current law in particular, we don't want to sell assets during lifetime. Particularly, we don't want to sell assets late in lifetime because death is really the one way to escape taxes. And it's not just because they can't come after you in the ground. It's because tax law is designed where all those gains go away.
Interesting. Yeah. So the two things that are unavoidable in life, death and taxes, but you might be able to use one to fight the other.
Yeah.
Interesting. All right. Well, guys, hopefully this video is beneficial. We're going to talk next about LLCs and what Evan's opinions of forming an LLC and when you should do it. So stay with me for that next video.